time for me to go back to basics on something called ETFs. I talk about them and fly through, and I have learned recently that I've just confused the daylights out of people by not giving a simple explanation of what they are, when you use them as an investment vehicle, and when you shouldn't. For most of us, unless you buy individual stocks, which most people don't do, even if you have people who buy individual stocks, usually it's a small part of what they do, and most of what they do is some kind of fund. And there are three main ways people buy funds. They can buy a mutual fund, they can buy an index fund, or they can buy an ETF. The fastest growing area of investing is ETF. So let me first start with the two old players. Mutual funds. A mutual fund is something where a manager, an investment manager, picks a particular investing style and buys stocks or bonds or both that are geared towards that investing style. And you are paying that professional manager for his or her expertise in picking specific stocks and or bonds, and then choosing how much of their portfolio to make that particular stock or bond, and when they decide to sell, increase their position, reduce their position, whatever. And you pay a management fee each year that can be substantial for that expertise. And that is a method of investing that many people do. Now, if you're going to own an actively managed mutual fund, you want to have it inside a 401k or an IRA, not in a traditional investment account, because all the trading that goes on in a regular mutual fund can clobber you at tax time. There's even a distribution that can happen each year with a regular mutual fund, which is known as an actively managed mutual fund, that at the end of the year you can get hit with a big tax bill if it's not held inside an IRA, 401k, or some other kind of sheltered retirement account. So mutual funds used to be everything. Now they're a smaller and smaller part of investing, because forever ago, a little teeny company started by a guy named Bogle called Vanguard, that's now the world's second largest investment house, came up with this idea for an index fund. And an index fund, instead of having an active manager, they just say, okay, we're going to buy the most popular, historically, has been the 500 largest stocks in the country. And so they would buy the 500, and you'd own a lot of American capitalism that way. And because the 500 largest companies account for a big share of publicly traded investing. So then this index fund, because it has much lower management fees, and because it's not being traded, buying and selling different things all the time, has much more favorable tax treatment. So it can be held inside a retirement account or outside a retirement account. And so that's where it started. Now there's like so many different index funds, and you've got the favorable tax treatment, the lower costs, and over time, a simple index fund will almost always beat, when you go out any number of years, almost every actively managed fund out there. Because an active fund manager may do well for a little while and look like they're the most brilliant person ever. And then those concentrated bets they make, oops, that doesn't work anymore. And the fund that went up comes back down. An index fund is just so my mentality, because I'm the turtle. Slow, although we were told by post on Clark Stinks, I'm actually the tortoise, is a better definition. Slow and steady, just like the way I run. So I just am happy to have the average performance of the market. Now, I'm a big fan of wide indexes. So I do the total stock market index is where I have the base of my money, where I own little pieces of the big companies, mid-sized companies, small companies, all in one. And then I'm a big, big believer in international investing. So I have an international index fund. And so that's my thing. You can get by with just a couple of funds. But what's happened in the index fund market is now there are so many that are sliced and diced that you're now looking at very, very narrow indexes. I made this mistake once. I bought a Chinese index fund because China was this growing economic power. I was like, well, they're growing much faster than us. I should have a Chinese sector index fund. Wow, did I end up being an idiot? Because, well, Chinese investments have not done well. Even as the Chinese economy grew and grew and grew, investments in it didn't do well. And it was an act of hubris because I'd always had this thing where you go broad, and then I went narrow. Stupid on my part. So you had this two-horse race, the actively managed funds, and then you had the index funds. Then comes along a third thing called ETFs, exchange-traded funds. And a very small number of companies dominate this market. And ETFs are index funds that trade like a stock. And there are advantages in them for long-term holdings or really short holdings because you can buy and sell them at will. And now with no trading commissions on buying most stocks, they trade like a stock. You can go in and out as you wish and not suffer from commissions. And so they have become where market share is moving steadily. The difference between an ETF and an index fund, marginal. In fact, with Vanguard, the same index funds are available pretty much identically as an ETF. The advantage of an ETF over an index fund, often the management fee you pay as a long-term holder will be lower from a lot of companies than the equivalent index fund. So that's really what it's about. And I feel like I've been remiss over the years that I talk about, well, index funds or ETFs without really giving an explanation. That was a quick 35-mile-per-hour windshield survey. If you want to understand it better, I guess the easiest place would be to go to investopedia.com and read the explanation of each of these three things.
We actually have an article on ETFs on Clark.com, an explainer.
We do?
We sure do, and I think it's very good.
Well, aren't I an idiot?
It's all right. Investopedia is great too. You know, we don't mind competition. We want people to learn, but we do have an article specifically on ETFs explaining. We have a lot of good investing content.